I'm also able to buy the chip manufacturers like TSMC, memory manufacturers like Micron. When a stock hits a new all time high, it often will hit more future all-time highs because it likely has good momentum. So I've developed a system that
Mm.
I've kind of come up with that has helped me prepare when I'm about to buy a stock.
Alex, good to see you. How you doing?
Good to see you, James. Doing great.
That's awesome. You ready to talk stocks and more?
Everything and more. Let's do it.
So, Alex, you've been a long-time investor, a lot of success, some failures. This episode, looking forward to talking about if you had to do it all over again, or you had the ability to, what you would do differently. What are some of the things that come to mind that you would do differently in a positive sense? And then I'll ask you, or we'll talk about what you for sure wouldn't do.
Yeah, so I think for starting off, when it comes to some of the ideas that I'd have to go back and redo, I think the first one would be passive investing. I was never the person that really understood how to properly passively invest. And granted, Robinhood and some of these other vendors now make it so much easier than it used to be. Believe it or not, when I first started trading, you actually had to pay for every single trade that you would make. So again, technology has changed and life has changed since then. But what I would do is I would usually hoard a bunch of cash and then I would wait to buy until my stock I wanted would pull back. And what I would find is ultimately some of these stocks would not pull back or they would run forever before I could actually feel good about doing that. But had I been passively investing in them, yeah, I might have been buying at the peak, but I would have been buying again and again as I grew with the stock. And that's where I became a really big believer in passive investing and allows me one, lower stress because I don't have to think about it. And two, making sure that my money's actually in the market because you don't want your money just sitting there in cash when, like we've talked about, inflation is going to eat that value away over time. The next thing for me is really getting into index funds. I was really focused on just finding the next big winner stock. That was my main thing, and I found a bunch. I've been in NVIDIA for a long time, Microsoft, Amazon, Google, Tesla. All of these are really good, but they've had some massive pullbacks over the past decade, and these are super stressful. You can see your investment just crash from there. And the way to get around this is with index funds that are diversified. And they help kind of like balance your portfolio out. And they're kind of like the safety net, if you will, because they're just way more stable. They're diversified, and there's going to be companies in there doing well, and there might be companies that are not doing well. And this makes it so if you do have one of those companies that's not doing well, you're not all in. So your portfolio just doesn't get hit as hard. And it took me a really long time to figure out how amazing passive investing was in combination with index funds. And so if I could go back, that's definitely where I'd be starting.
Unpack that a little bit. So, an index fund is a collection or a group of individual companies, right?
Yeah, that's right.
And
And
then go ahead.
you you can think that they are grouped by company size. You know, you can do international companies, you can do tech companies. There's all kinds of different types of index funds.
And then within the index fund, do they often put competitors in there? For instance, like a NVIDIA and an AMD, or how do they typically structure it?
Yeah, so there's one that you're talking about that does exactly that. And so if I'm extremely interested in wanting to invest within an AI or chips index fund, I can invest in SMH. And this is one that I've recommended before, and it'll buy companies that play in the entire sector. So not only am I buying NVIDIA and AMD, I'm also able to buy the chip manufacturers like TSMC, memory manufacturers like Micron, and it kind of allows you to get into a specific thing that I believe in. And it's a great way to kind of play the field from there.
If one of those companies that are selling chips has a bad quarter, let's say, or something happens, or they had a fire in some factory that slowed production or any of the million things that could go wrong.
Yeah.
If you have an index fund, though that stock, the individual stock drops because of whatever happened, the category or the index fund is still doing okay because it's and diversified against many other companies. That's the gist of it, right?
That's exactly it, and think of it almost in another way too. Let's say there's a fire at AMD, and granted, this is a bad example because they use the same manufacturers. So I guess maybe in the case of a fire, it would be bad for multiple companies because they use it. But let's say AMD starts losing share in chips. Well, NVIDIA stock will probably go up. And so that way you're capturing both the downside of AMD and the upside of NVIDIA all in one fund. So that way your bases are covered.
Is there any concern or any gotcha or anything to just clarify about an index fund that you got to be aware of?
Yeah, for index funds, I think the secret thing that a lot of people don't recognize, and I don't think it gets talked about enough, is fees
Mm.
that go along with it. And these are called the expense ratio.
Hmm.
And you can think of the expense ratio as basically the fees that pay the management team that runs the fund. And they can range from hundredths of a penny in percent all the way up to several dollars in full percents. So you can see as I start scaling my money and getting in thousands and stuff, those fees will eat into my gains big time. And so whenever you're investing in an index fund, you need to pay attention to fees and try to find the lowest ones to pick from.
And how are those fees applied or charged to you?
So those basically just automatically get pulled out as you invest from them. So let's say that you make 10% and the fees are 1%. Your account will really only reflect 9% gain because the company is going to grab a percentage of that annually from you. And it really just depends on the schedule for each index fund. It kind of can change, but basically it's an annual thing of how much they're taking from you.
Is there anything you were doing in those early days that you would for sure not do?
Yeah, there's a couple of things that I would definitely not do, and obviously everyone makes mistakes. I made several that I was able to at least learn from. And I think the biggest one that has impacted me that I will never do again is just blindly listening to tips of stocks to buy. And the key thing here is when I go search for stocks online, on YouTube, whatever, I'm going to be hit with a million opinions. And there's going to be a lot of stocks that people are super passionate about that they want you to buy. And I learned some of these people are doing it because they own tons of the stock and want you to buy it. Like they're not necessarily doing it for the best intentions. And so I would buy stocks after I would read, and I really wouldn't understand the company. And then ultimately, I would regret it because the company would not do well and the stock would go down. So the way I fixed this was I don't mind getting tips on companies, but what I usually do is kind of just put them on my radar to then go and research before I would ever do anything about it. So I fully recommend if you ever hear a stock from us, from any channel on YouTube, to go and do your own research because there are a million opinions out there and you need to build your own before you commit your money to it. I think that's a really big one. Another big thing that I've been hit with is you hear the advice of don't buy the peak all the time. It's one of the like the cliche lines. And what I've actually found is when a stock hits a new all-time high, it often will hit more future all-time highs because it likely has good momentum when these things are happening. And this feels really counterintuitive. But I really don't mind buying stocks at their peak pricing if I believe their story is really good and there's a reason why they're peaking. These are often sometimes the best signal to you that this is a high quality company that people believe in, and it will often continue to go up. And granted, there's always instances where you see it hit the peak and things crash. So like this isn't blanket advice for that, but I'm not afraid to buy at the peak, and I don't think you should be either if there's a really good story and a reason behind it. So those are kind of my 2 biggest learnings that are almost kind of myths and stuff that really happens to a lot of new investors out there.
Maybe you could share a little bit here, the highlights on that process that you go through for researching a company or individual stock and or the research you do to pick an index fund.
So I've developed a system that
Mm.
I've kind of come up with that has helped me prepare when I'm about to buy a stock. And it kind of goes into three buckets. The first bucket is all about fundamentals, the second is price and valuation, and the third is narrative. So the first bucket really goes into what does the company do, how do they make their money? And what competitive advantage do they have versus their peers? I'm a big fan of trying to target the companies that are the best at what they do. And I think NVIDIA is the perfect example of this. They're a 90% share when it comes to their chips, and they are the best at what they do. So that immediately gives them an advantage versus their peers and makes it a stock that is probably going to outperform just because they're positioned really well. The next thing when it comes to price is really how is the stock priced relative to that company? So, what I mean here is what is the stock price versus how much money that company is bringing in? And what I'm talking about here is price to earnings ratio. And so you'll hear thrown around, oh, what is the multiple for that company? This is what people are talking about. And when I'm looking at tech stocks or these really hyper growth stocks, you want to look at forward price to earnings ratio. And what this starts taking into account is how fast is the company growing and really what is their valuation if they do hit that growth. So for a company like Nvidia, this is the reason why current quarters don't matter as much and it's more future looking because people want to know is this growth going to continue? So that's something that's really important. And if a company is overvalued, it doesn't matter how good they are at what they do. The stock will probably pull back because people will eventually figure out that they're not worth the money. So that's why price and valuation is really important. And then finally for narrative, this is really like what is the company's story that they're telling shareholders and what is the sentiment around their industry? So sticking with Nvidia here, AI kind of has a black cloud over it right now after this insane run and people are questioning is the payout and all of these billions of dollars worth it? What is the ROI? And you've seen NVIDIA's stock kind of stall out because of this, just because the narrative has not been there. So you can kind of see how these three buckets group everything together and it allows you to make a good decision based off of all of these. And it's a system that I use to this day and it helps me kind of organize my mind and make good decisions from there.
For the sake of the listeners and for me when was first starting, what does pullback mean?
So when I'm talking about a pullback, I'm talking about if I see a stock trading at $100 and let's say earnings come out and they underperform or the analysts don't like the quarter, the stock might pull back $10 a share. So when I'm saying pullback, it means I'm seeing a decline in the share price. And they usually can talk about it just from a percentage pullback or an absolute dollar pullback, depending on how big the company is. So these usually are in response to earnings or major events that have happened, or there could be big macro events, kind of like what we're dealing with the war right now.
And are pullbacks permanent?
So most of the time, pullbacks are generally either a correction in some sort of trend, or it means there's something that really failed within the company. And usually what happens is around earnings, you see the stock respond. So it's going to probably go up or down. Very rarely do stocks just stay flat right after their earnings. And what happens is people kind of digest the new information and people kind of take that new information to see what's going to be happening or making like an update to their predictions for the future. So sometimes news will come out and something catastrophic will happen. Somebody could be having their blockbuster moment and to your point, there's either two things that can happen. One is there's something seriously wrong and it will not return. Or two, it's just unfortunate and actually an opportunity for you to buy.
What's the name of that field that identifies the index fund fee?
This will be noted as the expense ratio for that index fund. And so when you go and click The index fund, you can go through all the numbers that it has with there, and part of those will be the expense ratio. So again, pay attention to that, as anything that's nearing 1% is really expensive. A lot of the basic ones can be like a tenth or less or a hundredth of a percentage. And these matter a lot once you start getting money in these things.
What would be some of the main core things that you want somebody to reinforce or to take away from today?
So I think some core things that I would take away is kind of checking off a couple of boxes when I'm a new investor. The first is coming up with a budget and sticking to it and being accurate with how much I can actually put in the market. Next is setting up passive investing so that I guarantee get to continue to use my money and allocate that correctly. And third would be having a nice mix of individual stocks as well as index funds. This will set me up for a ton of success in the future. And then start dabbling with all the other advice that we talked through that you can start sprinkling in as you start getting more experience. But that's really it. Those three things are going to set you up and set you up way better than I was when I first started.
That's great advice. Thanks for talking stocks, Alex.
We'll talk to you soon.
Well, wait, we're not done. Hold on. We got to share what we're talking about next
And more.
and more. What are we
The-
talking about next?
I think the next episode's the capstone.
Which is our cliffhanger season finale. If there is a cliffhanger, you have to listen. I doubt that there will be, but I'm kidding. If you're listening and you have ideas or things you would like us to cover in this next season, please share that. We're interested to see if this was helpful, as well as to see if you have anything you'd like us to discuss or hear from Alex on. So, Alex, thanks for talking stocks with us. Look forward to next week.
Absolutely. Can't wait.
Talk to you soon
And more.
and more. All righty.